Mute, thank you for the morning. Mute, please. So there are some notes I prepared and shared with you. I want us to go through them. So let's go through the notes on cash flow, which I shared with you. Someone joining with the techno, please identify yourself. Who is that? I've never seen techno in this class. Kindly tell us, there's someone with the techno. Who are you? Matutoya. So IS number 7, statement of cash flows. We go through the handout together. There is the handout I've shared in the group on IS number 7, statement of cash flows. So I want us to go through that handout, then we can check the related questions for cash flow. So open that handout, kindly open that handout. All right, so let's go through that handout. The objective of IS7 is to require the presentation of information about the historical changes in cash and cash equivalents of an entity by means of the statement of cash flow. Those are stories. So cash flow, we just check the changes in cash in, cash out. And cash flow is viewed from three activities. That is operating activities, investing activities, and financing activities. Those three. So when you are told to give us the statement of cash flow, you need to tell us the cash which was generated from operations, from investing, and from financing. So you give us both cash inflow and outflow in relation to those three activities. So our main concern at this point, we need to know which are these cash flow from operations, investing, and financing. So back to the notes. Operating activities are the main revenue generating activities, i.e. sales, cost of sales, administrative, and selling and distribution. So mostly those are the operations, because those are what we deal with on daily basis. We do sell, we incur cost of sales, administrative, distribution. It also includes cash received from customers and cash paid to suppliers and employees. Correct. So if you are analyzing cash you are receiving from your customers on daily basis, cash you have paid suppliers, the ones you have paid employees, cost of sales, revenue, those are daily operations. Then you categorize them as part of cost of, as operating cash flow. Investing activities are the main acquisition and disposal of long-term assets and other investments that are not considered to be cash equivalents. So investing, mostly, we check acquisition and disposal of non-current assets. Can you understand that? Investing, when we are presenting cash flow, under investing activities, we check the cash flow which we generated from sale of assets or acquisition of assets. That is all about investing. Financing activities are activities that alters the equity capital and borrowing structure of the entity. So when we talk of alteration of capital structure, those are loan acquisition, issue of shares, loan repayments, among others. So anything touching on equity and long-term loans, we take them under financing during presentation. So you need to know what to classify under which activity during presentation. So operating, we have said what goes there. Investing, we have talked of disposal and acquisition of non-current assets. Then financing, we have talked of alteration of the capital structure of an entity. Note, interest and dividends received and paid may be classified as operating, investing, or financing cash, provided that they are classified consistently from period to period. What does that mean? Interest and dividends, you can classify them in any of those three activities, provided your classification is consistent from year to year. Not this year it is under operating, the other year. You know, some people argue that we are paying interest because we have a loan, and loan is part of financing, so they will classify interest as part of financing. Some people will say we received interest from our investment, and therefore we take it to investing activities. Some people will say we normally have overdraft, daily overdraft. So interest is meant for normal operations, is charged due to the normal operations, and they take it there. So in real practice, those two, you can take them anywhere. Take them anywhere. For class, interest, I'll take it under operations, while dividends, I'll take it to financing, because my argument is that we pay dividends to shareholders, and shareholders are the financials of the company. So dividends will be charged to financing activities. Methods for presentation. So we have two methods for presentation. Not individual method. It is called indirect. Whoever typed for me this mess. Indirect method and direct method. So we have two methods for presentation. Though the one which is normally used is the indirect, the first one, indirect method. It adjusts net profit before tax for the effect of non-cash transactions such as depreciation, impairment, etc. It also takes into consideration the working capital, that is current assets and current liabilities, into account. So when you present cash flow by starting with profit before tax, then you adjust that profit, then that method is known as indirect method. So under indirect method, you start with profit, then you adjust items which are not operations. Operating items is revenue, cost of sales, administrative, distribution. Those four. Those are the operating activities. Any other item apart from those ones, we adjust against profit, and that method is called indirect. And it's the one which I will always prefer you use. Direct method, it shows each major class of gross cash receipt and gross cash payments, including cash receipts from customers and cash payment to suppliers and employees. The main limitation of direct method is that it fails to take into consideration the working capital components. So direct method, you just tell us how much you receive from your customers and how much you have paid to suppliers, period, nothing much. So you go direct, what you have received, what you have paid. You don't have to adjust the profit. For operating cash flow, the direct method of presentation is encouraged, but the indirect method is acceptable. Those are just stories. So check the format of indirect method down there. So when applying the indirect method, you start with profit before tax and operating activities. So operating activities is the one which starts. Operating activities is the one which starts, in which case you start with the profit before taxation. You adjust. So this adjustment, you adjust for items which are non-operation. Operations are these ones here. Those ones. So when you are adjusting profits using your secluded, this four, any other income or expense apart from these ones, those are not operations. You add them back because they are being utilized to reduce profits, but they are not, operating are the ones we count daily activities. So things like depreciation, yes, we acknowledge that depreciation is an expense, but we incur that on daily operations. So you add it back. Similarly, depreciation is an uncash expense. There was no cash flow. Cash flow is checking in and out. So depreciation, there is no money which was incurred. There was no actual cash outflow. Add it back. Furthermore, it is not an operating expense. So you add back depreciation, the sisters of depreciation like in impairment and amortization, you also add them back. Then any income apart from revenue, you subtract gain on disposal, investment income, you subtract them from operations because we don't get that on daily basis. So that is all about adjustments. Then you bring working capital. Working capital, you check increase in current assets, decrease in current, it just changes in current assets and current liabilities. In which case, you check increase or decrease in current assets and current liabilities. Then investing, cash received on disposal, cash paid to acquire PPE, cash received on disposal of a subsidiary, among others. So for investing, you just check disposal and acquisition of your investments and assets. Then you adjust there. Financing, cash received on issue of new ordinary shares, dividends paid to non-controlling interest and holding company, finance cost paid, loan acquisition, loan repayments, all those ones you bring them at that stage. Then when you go to direct method down there, under direct method, operating activities, you just tell us cash received from customers, cash paid to employees and suppliers. Then the difference is called cash generated from operation. Then you give us tax paid, and that is all. Note, investing and financing activities are similar in both approaches. So whichever method you use, investing and financing will always be the same. They only differ on operating activities. That is why I've not given you the other two. So they are the same in whichever case. So at this point, allow me to check an illustration. I don't know if cash flow was there last sitting. Just give me a minute. There's someone who had shared the, it is here. Let me share. There we are. So anybody without the paper, I've shared it in the group. Let me check if there was cash flow last sitting. Cash flow statement. Yes, there was. Question 4. I did not carry my paper, so I'll be using my phone here, which is hectic. So check last sitting August 2023, question 4. Watatu angalia hiyo swali. So let's check last sitting, question 4. I believe everyone is there. Believe everyone is there. People are there, so allow me to read. No, my paper. Just a minute. Logo. Just a minute. I think I've sorted out that. My phone was misbehaving here. So allow me to read the question. Allow me to read the question. It says, Lilongwe Limited is a public listed company. Details of the company statement of financial position as at 31st March 2022 and 31st March 2023 are shown below, together with other relevant information. Sawa. So, statement of financial position, we have the balance sheet there for 2023 and 2022. As you can see, no problem. No need of reading those things one by one. Let's go to the additional information. Number one, details of property, plant, and equipment as at 31st March and 31st March 2022. As you can see, so land and buildings, then there was plant. We have been given their costs, their depreciations, and carrying amounts. Carrying amount is the net book value. And also 2022 cost, depreciation, carrying amounts, no problem. The company revalued the carrying value of land and buildings by an increase of 70 million on 1st April 2022. On 31st March 2023, it transferred 3 million from the valuation reserve to retained earnings, no problem. relating to depreciation or devaluation of building. During the year, the company acquired new plant at a cost of 60 million and sold some old plant for shillings 15 million, incurring a loss of 12 million. The following is the statement of profit or loss extract for the year. So operating loss, interest receivable, finance costs, loss before tax, income tax repayment claim, deferred tax charge, fine. Loss for the period, as you can see. Finance costs are made of interest expense, then penalty for early loan redemption. Short-term deposits are deemed as cash equivalents. Dividends of 25 million were paid during the year. Required cash flow statement for L Limited for the year ended 31st March 2023, in line with International Accounting Standards, IS number 7. Cash flow statement. Perfect. 14 months. So, of course, we are going for the indirect method of presentation. So I don't think if there is anything, we will meet those things as we progress. So the best is just to kick off. So right there, they are calling themselves who? Lilongwe. So shillings are in millions. How one column. So operating activities. Be there. So operating activities, we normally start with profit before tax. But in this question, it is a loss. So it is loss before tax. That is what you need to capture. The loss before tax, which can you check and tell me how much you can see? So loss, right here, profit, so loss before tax. How much are you seeing in the question? I just want to make sure we are together. How much are you seeing? It is somewhere there. Arizona, 32, 44, 21. 3 people having different answers. We must harmonize that. That one needs harmonization. Please check and be sure. Olive, you have changed to 45. Someone else? Because now those are 4 different answers. Loss before tax is 44. I hope you are seeing the 44. Loss before tax. Not operating loss. Operating loss. You take the loss before taxation. Loss before taxation. Kindly. So loss before tax is 44. So that is negative 44. Then you say adjust. Adjustments in cash flow. Immediately you write adjustment. The first thing you write is depreciation. The first item you're supposed to write there is depreciation. So we need to check the depreciation charge for the year. There are some notes here we need to be very keen. The arrangement is quite funny. Check for me land and buildings. The depreciation on land and buildings, 2023. Check for me depreciation on land and buildings for 2023. How much are you seeing? How much are you seeing? Olive, 80, really? 80 is 80 2023? No, 2023 is 12. Olivia, check well. 2023, the 80, yes. So 2023, building, there is depreciation of 12 if you check it keenly. So depreciation on buildings, there is depreciation expense of 12. So that one you add back. Then check depreciation for plants. Check depreciation expense in relation to plants. So plants, I'm just checking if there is. How much? Yes, 148. Plants, I can see depreciation. Depreciation on plants is 148. Yes, plant is 148. So you add that one there. That is okay. Then the next item, you check if there was amortization. Amortization, how will you know there is amortization? You go to the balance sheet, you check if you have intangible assets. If there is a decrease in value of intangible assets, then that is amortization. So can you check your non-current assets up there? Check your non-current assets up there. You are seeing intangible assets. At the beginning, it was 510. At the end of the year, they are reporting 400. So that decrease means there was amortization. Because the value of intangible assets, I hope you are seeing it, under non-current assets in the balance sheet, it was 510, then it went down to 400. So that one means it was amortized. So amortization of intangible assets is 510 minus 400. That one will give you 110. So that one also you add back. They are not operating expenses. You add back. Then after that, check whether there was disposal of any assets. If there was disposal, check whether we disposed that asset at a loss or at a gain. At a loss or at a gain. So there was disposal, check additional note, yes, note 3. So I'm told to check note 3. During the year, the company acquired a new plant at a cost of 60 and sold some old plants for 15 million, incurring a loss of 12. So that loss, lazima walikuwa wametoa kama expense, but it's not an operating expense. So you add it back. Loss on disposal. Loss on disposal, you add back 12. That one you add back 12. Perfect. Perfect. Then go where we had the loss before tax in the profit account, note 4. Profit account is in note 4. Check where we had loss before tax. So I want you to go backwards. Loss before tax. What if it was a gain? You just subtract. Gain on disposal is not an operating income. The only operating income we consider is revenue. So if it was a gain, Joshua, you just subtract it out. It is not an operating income. We don't receive it on a daily basis. So go to note 4. You are seeing loss before tax. So we go backwards. The items which gave us the loss, then you adjust for non-operating, the non-operating ones. So the first one, when you try to go backwards, is finance cost. Finance cost is not an operating expense. It's not an operating expense, so add it back. So finance cost, this is 24. They are subtracted, so you add back. Then there is interest receivable. Interest receivable is not an operating income. So they are given as 12. That one you subtract because they are added, but it's not an operating income. We are done with adjustments. That is how we do the adjustments. So can you tell me the figure? Tell me that figure. So that one, thank you. That one comes to 250 positive. Then you bring working capital down there. So this is called the name cash flow. Cash flow before working capital changes. Working capital changes. Cash flow before working capital changes. Then now I want us to bring the working capital. So you bring your working capital down here. I'm lacking space, so I'm going to the other side. You just bring it down there. So working capital. So working capital, current assets and current liabilities. And you only check increase or decrease, as simple as that. You only check increase or decrease, period. So let's go to current assets. Inventory was 420 at the start. So inventory was 420 at the start. It went down to 350. That is a decrease. So tell me decrease of how much? So decrease in inventory is 420 minus 350. That is 70. Is that 70? The 420 minus 350. So that is a decrease. So that is 70. Do we add or we subtract? Because hapo pia watu unapata answer, like instead of adding to subtract, or instead of subtracting, someone has added. Decrease in inventory. Should we add or should we subtract? Brian, we should add. Yeah, when stock goes down, you know this is cash flow. Decrease in stock means you are selling. So if you sell, it means you are getting the money. So you add. Decrease in stock, you add. Let's go to receivables. Let's check receivables. Receivables at the start was 372. It went to 808. That is increase. So increase in receivables. So this is 808 minus 372. How much is the increase? How much is the increase? $436. So 436, we add or we less? We less. Increase in, you know the same with the debtors. When debtors balance increase, it means you are selling on credit, where we collect pesa. So pesa yako ikuko nje. So this one, you subtract. Then next, interest receivable, no. Interest is not a working capital. Working capital, where we have stock, receivables, and payables. Interest will go to investing down there. So let's go to trade payables. Other current liabilities. At the beginning, payable was 515. It increased to 530. So increase in payables. 530 minus 515. That one gives you 15. That one you add. You know payables are creditors. When creditors balance goes up, it means wewe haulipi madeni, uko na pesa lakini haulipi. So it is cash flow. Only those ones. Those are what I need you to check on working capital. So cash generated from operations. You start from 250. The 250, the cash flow before working capital changes to 50. Then you adjust for all that. Can you do that, please? Thank you. So people have given me negative 101. Then you bring here tax paid. Tax paid and interest paid. Those two, once you bring these two, you are done with operating activities. So I want us to check the tax paid and interest. Question, where are you? Okay, so here we will have to be very thorough. For tax, let's have a small working outside there. So have a working, call it working one, taxation. Call it taxation. There are some people making noise. I'm requested to mute them. So taxation, this is how you go about it. You check the tax obligation at the start of the year. Then we will compare with the closing to know whether we paid. So balance brought down. Check both deferred and current. So check non-current liabilities and current liabilities. So at the beginning, you can be able to see deferred liabilities at the start of the year. If you are keen, you will see 75. Please don't copy, make sure you have seen it. So this is 75 plus current tax. Check current liability, there is taxation of 110. I hope you are able to see those figures in the balance sheet. In the balance sheet. So I hope you have seen that. So it comes to 185. It comes to 185. Then P&L for the year. So that was the obligation at the start of the year. The 185 was an obligation at the beginning. So check profit account. Profit account down there, when you check, you'll be able to see income tax repayment claim 14, deferred tax charge 15. So total tax expense is only 1. I hope you can see the 1. So during the year, we had only tax obligation of 1. We only had tax obligation of 1. I hope you can see the 1. For current tax, we were claiming 14, but the deferred tax we were expected to pay 15. So they netted, they offset deferred and current to get 1. Correct. So compare, skip one line, then you compare with the closing balance. Compare with the closing balance of tax. So closing balance under non-current and current liabilities, deferred you will see 90, current you will see 15. Check, please don't copy, make sure umeona where the figures are coming from. This balance current down check deferred under non-current liabilities, you see deferred 15, current 90, then current 15. So the tax total was supposed to be 186. But when we check the liabilities at the end, is a total of 105. So it means they paid. So there was tax paid. The balance is bigger. How much? Mohammed, we cannot subtract. You don't negative, they subtracted because it's an expense. Unaona the fact the current tax is there 14, you are claiming 14, deferred was 14. It means our total tax expense is 1. So we had a liability of 185 during the year. We had a liability. Remove the other arrangement. You don't go to. Where is tax? We were claiming 14, but the deferred tax expense was 15. So yeah, so we had an expense of 1. So 1 is an expense because we were claiming 14, but we had deferred tax of 15. So the claim is 1. So the 1 is part of liability, should be part of liability. So you don't subtract, Mohammed. You can't subtract, it's part of the liability because it's an expense. You can only subtract if it is a claim, if it was positive, is when it can reduce. But this one negative will be added. Good. So Joshua is saying it is 81. These people paid 81. So if that is okay, you take it to the cash flow. You say working 1, they paid tax of 81. So total tax is 81. Then I want us to check the interest. I want us to check interest. Interest is the finance cost. So interest paid, big in somewhere, there's something I saw somewhere. Check P&L, the note before note 5 in the P&L. Check the note before note 5 in the P&L. The P&L. They said finance costs are made of interest expense and penalty for early loan redemption. So what we need is the interest, not penalty. So penalty on loan, that one we are going to capture when we are dealing with the loan. So what we bring here is the interest, which is 18. So interest paid, we bring there 18. Meaning that cash flow, we are done with this. Cash flow from operating activities. Give me the answer, then you call it A. All of them are negative, so it will just be a big negative. So give me that figure. Olivia is getting 200. Yeah, very possible. So it comes to negative 200. Lakini kwa nini swali nakaa huyu jamani alipuli tu mahali na akafix. Hiyo swali yake ikae vizuri vile. But ni sawa. We have to comply. We want to go to investing activities. We want to check investing activities. Investing activities. I told you go to non-current assets. For investing, you focus on non-current assets. So investing, just check the acquisition and disposal of assets. So let's go to the notes. So investing is all about assets. So note 1, note 2. The company revalued the carrying value of the building at an increase of 70. On 31st, there's a transfer of 3 million from revaluation to retained earnings. No problem. Relating to depreciation. Okay. The depreciation of the building inaweza kuwa na issue, but we'll check. Now there was a transfer. Number 3, I'll check later. During the year, the company acquired new plant at a cost of 60 million. So acquisition of plants. So cash paid to acquire plants. Cash paid to acquire plants. In that note 3, they acquired a new plant at a cost of 60. That is cash outflow. That is okay. And sold some old plant for shillings 15 million. So cash received on sale of plants. When they disposed the plant, they received 15 million. That is cash inflow. Then next, let's check if there was anything on building. Let's check if there was anything on building. So building. Was there anything touching on buildings? Yes. Can you check this building? Note 2. Yes, note 2 is what I'm trying to check. Can you just have a small working for building? There's something I want to check on buildings. There's something I need to check on buildings. So buildings, what was the opening balance? Balance goes down. Of course, you check the carrying amount. The carrying amount of building in 2022. 2022, the value of the building, land and building was, the carrying amount was for 20. The carrying amount in 2022 was for 20. Please make sure I'm on. Yes, was for 20 at the start. Then during the year, they are saying in note 2, the company revalued the carrying value of land and buildings by an increase. The company revalued the carrying value of land and buildings by an increase of 70. So earn revaluation. Earn revaluation. Revaluation is 70. Revaluation they have said is 70. Less depreciation during the year. So depreciation, you capture depreciation in 2023, which is 12. So depreciation, remember this was the closing net book value last year. So last year was this, during the year we revalued this, during the year there was depreciation of 12 on land and buildings. If you check it in. Therefore, how much is the closing? The closing should be that figure. I'm just trying to check. Olivia 478. 478. But according to the examiner, what is the closing value for buildings in 2023? They are closed with 588. It means they acquired. That is what they are not telling us. They acquired more. They acquired more buildings. The balancing figure is acquisition. Acquisition, the balancing figure of how much? 110. So there was acquisition of land and buildings. Have it there. That is what they are not willing to tell us. That is what they are not willing to tell us. Thank you. So That is cash outflow. So cash paid to acquire land and buildings. You can call it working too. We have gotten 110. That is cash outflow. That is cash outflow. Then under investing, you check another non-current asset. The other non-current asset is intangible. Intangible, we got amortization, so we forgot about it. The only item I want to capture under investing is the interest receivable. There was the element of interest receivable, so we need to bring it here. You come and say interest received. I saw it twice somewhere. Yeah. So come here and say interest received. Interest received. Interest received. I don't want to do a working. There's something we can do. Check current assets. Check current assets. If you check current asset, how much was interest receivable at the beginning of the year? Just want to check if you can be able to see it, then we are good. How much was receivable at the beginning of the year? 3. Yes. Receivable at the beginning, we can see 3. During the year, check P&L. Check P&L for interest receivable. Interest receivable P&L, how much are you seeing? Interest receivable in the profit account, 12. Yes. So at the beginning, we were supposed to receive interest of 3. During the year, we were entitled to 12. So it means at the end of the year, if we have not received, then the total receivable should be 15. 3 plus 12. Beginning 3, during 12. Then at the end of the year, we are being told interest receivable is 5. So it means we received how much? 10. Because the interest went down. Interest went down. So that is all. So can you add and call it B? That is cash flow. Cash flow from investing. Investing activities. Give me that figure. So people have gotten negative 145. Negative 145. So the only one remaining is financing. Financing activities. So right there, financing activities. Then financing, you go to equity and loans. You to equity and loans. So financing, you want to go to financing. Unless someone has a question. If there is no question, then let's go there. Financing activities. Financing activities. So financing, we go to equity. So let's go to the equity. We do some small analysis there. So under equity, you are seeing ordinary shares, share premium. You are seeing revaluations. Hizo figures vile zimepangwa utabidi tuangalie vizuri tusikosee. Then there is retained earnings. Yes, there is retained earnings. So you start with ordinary share capital. So ordinary share capital, mostly, we check whether the company gave out shares. And how will you know they gave shares? If there is an increase. Increase in the value of shares means they issue. And shares are not issued for free. They are issued for cash. So come here and tell me, cash received on issue of new shares. Cash received on issue of new shares. So check the closing value of ordinary shares. Combine ordinary with premium, kindly. Combine ordinary with premium. So ordinary closing, if you check keenly, you'll be able to see 300. You'll be able to see 300. And the premium, you'll be able to see 60. So this will be 300 plus 60. So it means they closed with 360 worth of ordinary shares. But what about the opening? How much was the opening so that we can see the increase? Opening was 200 plus nothing. There was no premium at the beginning. So 200 plus 0. So it means the increase was 160. Because this is 360, initially it was 200. So the issued shares were 160 for cash. So bring that one there. Then we go to the next. We go to the next item. Just a minute. I hope the arrangement is perfect. Just confirming something. I don't like how this question is arranged. We can mess if we are not keen. So we'll just have something there. So the next item, the next item Where's the next item? The next item is revaluation reserve. Revaluation hakunanga pesa unapata ukirevalue the assets. So that one, ignore, wachana nayo. Go to retained earnings. Retained earnings should be utilized. You utilize retained earnings to determine dividends, which you paid. The decrease in retained earnings is dividends. Profit ikipungua, it means the company has paid dividends. But now, sometimes they normally dictate what they paid, so you don't have to check the decrease. Like in this question, they dictated, I saw it somewhere. It was in note number 6. Check note 6. Check note 6. Dividends of 25 million were paid during the year. So you bring them here. Dividends paid. Dividends paid. They paid dividends what? 25. That is cash outflow. So equity is over. Otherwise, if they don't give you dividends, please understand that. If they don't give you dividends, you just compare the opening and closing. Decrease in retained earnings is dividends. Hope that is clear. Then we go to the next. Equity is over. So go to non-current liabilities. Go to non-current liabilities. Non-current liabilities, the first one is 12% loan notes. 12% loan notes. The loan notes at the beginning, it was 150. At the end, it is 0. What happened to that loan note? I want someone to tell me what happened. What narration can we give there? The loan note was 150 at the start. At the end, it is 0. What could have happened to the loan note? Somebody? Yeah, Francisca, we paid, correct. So repayment of, it is 8% from which percentage? Repayment of 12% of 12% loan notes. The whole 150. That one was paid. Where has it disappeared to? It has been paid. They paid that loan notes. The next one is the 8% variable rate loan notes. So the variable rate loan notes was nothing at the start. I hope one alone. There was nothing. Yes, there was nothing. Then at the end, 160. 160, but check note number, there was a note. Check note number, which one? Before note 5. The note before note 5. So it means hapa tutaweka change. You see, they have said the small note before note 5, there was penalty for early loan redemption of 6. You know, this is the loan which they redeemed because they paid. You know, redemption kama wanalipa. So they incurred, they were charged 6 extra. So it will be 150 plus that 6, the penalty. So right in your book, 6 is the penalty. So here we need to talk of 156. Examiner just more. Then the other loan notes, at the beginning, it was 0. At the end, it went to what? 160. So we acquired. So acquisition of 8% loan note 160. That is cash inflow. Walipata pesa because at the beginning hatukuwa na loan. At the end of the year we have the loan. So that is cash inflow, and we are done. We are done. We are done with financing activities. So can you call it C? Thank you. 139 positive. So this is cash flow from financing activities. That is 139. So I want you to give me the net cash flow. Net cash flow will be A plus B plus C. Can you add for me the three? A plus B plus C. Combine all of them. Negative 206, but Francisca got a positive 84. So, Dr. Check. So people have said 206. So this is negative 206. So Francisca, I hope you have checked. I hope you have checked. So we want to wind up with cash and cash equivalents. Cash and cash equivalents. So you come here and say cash and cash equivalents. Brought down. So if you add the cash and cash equivalents brought down, you're supposed to get cash and the cash equivalents carried down. Like that. So have the last working for cash and cash equivalents. Cash and cash equivalents. So 2023, 2022, have them there. For cash and cash equivalents, check just a minute nifungue yangu. Check current assets. Check current assets. Under current assets, you will be able to see bank. Bank, I'm seeing 15. I hope that is the correct figure. Bank, there is 15 at 2023, then the other side, 75. Please confirm if the figures are in order. So this is 15 bank. Bank is 15 and 75. Then there is the short-term deposits. Short-term deposits are cash equivalents. Short-term deposits are cash equivalents. I think even they said it somewhere. I'm just trying to check. I don't know. Number 5. Yes. Short-term deposits are deemed as cash equivalents. Yes. Even they say it. But even if they don't say, short-term deposits is a cash equivalent. So that is 32. I'm seeing 32. And the other side, 120. I hope that is okay. So short-term deposits. I've seen how much and how much? 32 and 120. 32 and 120. Then there is bank overdraft. Bank overdraft is a negative cash equivalent. So go down there for bank OD. So bank overdraft. Bank overdraft, I'm seeing 125, just confirm. Then the other side, I'm seeing 0. So 125, you subtract and 0. So can you add 2022? That is 195. 195. Kwa nini hiyo kitu haijani? 15 plus 32, you get 47 minus 125, it comes to 78. 78. So cash and cash equivalent at the beginning should be this one here. 195 positive, then the closing is 78 negative. But when I check 206 minus 206 plus 195, That is coming negative 11. While this one is coming negative 78. There's a variation of a certain figure there, which I really suspect that depreciation of buildings, but I will not even waste my time because even the way they are writing that question, I think it was just pull and paste from somewhere. That is not an issue. But you must finish with the correct answers. This one's here. So in this question, student was just required to get 7 ticks. So 7 ticks, I know where you can get them without problems. No, that one you can get. There are so many. By the time, let's check, not now. I want to leave you with the next question, which we are doing later in the evening. You are going to find out when you finally ask me. Where is cash flow? There was no cash flow in April. Oh, April 2023, there was no cash flow. Statement of cash flow. Yeah, there was cash flow in December 2022. Yes, Olivia, December 2022, question 5. So right there, December 2022, question 5. You can even try this question before that class. Then when we solve, you can see maybe 1, 2. This one, there is just one variation, I think 60 something, which we don't want to waste time. I really suspect their building was having some issues, which we don't want to venture into those stories. So let's solve this question. We are meeting at what time? 2 at 2 p.m. So let's meet at 2 p.m. Ukifanya hiyo moja tu tumemaliza. So we might not go up to 5. Once we're done with that one, that is the end of the class. Then now we shall meet for another topic in the next. So I want to settle down. I share with you. Yes, I'm in school, Daniel. I want to share with you one question published. I'm sharing a video plus the solution and promise. We did 2 questions, so I'll share that one and this. And even this one, once we are done with this other question, I'll do another one, then I share with you a video plus that one so that you can supplement Evo. So otherwise, thank you. Please make sure mmepanda miti. Hata ukipanda kwa shamba ya wenyewe, sawa. Wewe panda tu. Thank you. Have a nice day. We'll meet later in the day. I'm in school. Whoever wants to come for physical, I'm around here.